Everyone. I'm Dr. Kara Tambala. I am the president of Seven Pillars Institute, and the Institute is the organizer for this event. And we wrote and also produced the video, which you're going to see soon. Just a quick introduction on Seven Pillars Institute. We are the world's only think tank focused on promotion, education, and research in financial ethics. We are affiliated with Queen Mary, University of London, and we are headquartered in Kansas City, Missouri. Our fellows and research associates work from all over the world, and we went virtual before the world went virtual, let's just say. So, and we found that actually that was much cheaper than going physical. So I want to say that we're going to show the video first, and then we're going to have the panelists speak. A quick introduction of the panelists, and I'll leave them to introduce themselves and their organizations more when they speak. Our first panelist is Chris Ritchie, who is the Managing Director of Silvercrest Asset Management, which I believe has about $25 billion under management. Our second speaker will be Josina Kamerling. She is the Head of Regulatory Outreach for Europe, the Middle East, and Africa at the CFA Institute. And we have Ruth Steinholtz, who is the Managing Partner at Arete Work. So without any further ado, let us just go to the videotape.
ESG investing takes into account the non-financial metrics of a company's record in environment, social, and governance of corporate issues. ESG funds take advantage of research that shows good ESG leads to good long-term profits. ESG investing claims to incorporate ethical and financial measures, two areas previously considered separate. The benefits of ESG can be judged by environmental improvement, socially responsible behavior, and ethical corporate governance. There can be good collateral benefits. However, ESG funds reward ethical behavior, but don't view such behavior as inherently valuable. They have a single goal: profit. ESG funds use ethical behavior to gain profit. Immanuel Kant might have something to say about this. For Kant, a behavior is moral only if its purpose is to adhere to the moral law. Morality is never a means to an end. For Kant, if the intention of ESG investing is profit, not the good, then ESG investing is not ethical. A huge number of ESG funds claim they are no-sacrifice funds. No sacrifice means exactly that, no sacrifice of profits for ethics. If you believe it's one's duty to follow moral rules, then the investor and the ESG fund would be willing to sacrifice profits for ethical principles. There are many ESG investing firms that do not sacrifice profits for ethics. They claim there is never a trade-off. They can have their cake and eat it too. Good is always profitable. Really? There are other problems in ESG investing. What makes a company an ESG-worthy investment? How are the factors measured? Who decides the metrics? What defines governance? Is ESG really measurable? A CEO can release his company's ESG report and be happy. But his company's investments were really made on an investment basis, not a philosophical one. The targets are institutional grade and market rate of return investments. ESG investing continues to gain in popularity in the marketplace. ESG investing is the expansion of factors regarded as financially relevant. The collateral results of ESG are beneficial, but it is the profit that allows it to function so well in the marketplace. A major challenge facing ESG investing is the lack of quantifiable factors that allow comparisons across companies. Without an objective means to analyze corporate behavior, greenwashing or a false claim to ESG behavior can be made and investors can be taken advantage of. ESG investing is a first step in considering the environment, society, and the governance of corporations, even if the true intention is not for the good of society, but for profits. Ratings and consistent ESG metrics would only make it better. Learn more about financial ethics at sevenpillarsinstitute.org and follow our financial ethics video series on YouTube, on our Facebook page, and on our website.
Well, Appreciate everybody attending today. I'll give you the practitioner's view. I'm a managing director at Silvercrest Asset Management Group. I oversee international and global equity portfolios on behalf of our client base. I've been at Silvercrest 2 years. The firm was formed in 2002. And I'll say this, from the practitioner's point of view, ESG is a good because the client wants to make an impact, positive impact with their money, and we're there to help them. And the concept's been around for 40 plus years. It's been under different names. I've come across it in the 1970s under the name socially responsible investing. And as portfolio managers for years, what we've been doing is sort of asking the client, you know, we're going to run a portfolio this way wide open. Is there anything you don't want in the portfolio? You know, weapons companies, oil companies, and we then exclude sort of on a one-off basis. What ESG and technological advances have allowed us to do over the last 20 years is create purpose-built portfolios for more wider offering out in the public, so that members of the public that want to have their money put to use in companies that are more positive in some ways than other companies, we're happy to do that. And there absolutely is a profit motive in this because we have to get paid to do it. We'd love to do it for free, but there's absolutely a business motive. Where the ethics get involved, I believe in this, it is in the transparency and the honesty with which the products are offered, and that the product is appropriate for the client in that instance, and that you're not pitching, have your cake and eat it. There is going to be a trade-off when you shrink the universe of companies that are available to invest in with these criteria. That's true of whether it's value investing, growth investing, or whatever. You're shrinking a universe and you're making a wager away from the core of the investment universe. And as you've seen in other instances, returns can be there and returns might not be there. But as long as you've transparently and honestly described what the process is and the client understands it and has the wherewithal to, I guess, withstand the downside of it, then that's fine. And that's how we do it at Silvercrest. We have an ESG Investment Committee and two ESG products. One is an environmental oriented product. The other is one directed at municipal bonds, municipalities in the US, to make sure that these are good municipalities. Hey, Car's back. And we have a committee of 10 people that was formed in 2017 to oversee those portfolios, and they are funds of funds. So we look through into the underlying portfolios, disclose those to the clients, and if it's a fit and that is what they want, we will provide it for a fee. So that's our background in it. From my personal point of view, before joining Silvercrest, we ran another firm that looked into ESG investing. And what we found was this, that ESG, if you break it down into the three components, environmental is fairly straightforward as a concept to screen for. It gets a little tricky at the edges. I'll jump to the chase here. The S part, the social part, is where it gets the trickiest and is the most subjective. G, to some extent, the governance of the company is knowable, at least from, I believe, the historic returns and how they've treated shareholders, because that's what the G stands for. In a broader sense, it also stands for the legal environment they operate in, is the regulatory environment of the country that oversees them, or where they are overseen. Are they compliant with those laws? Are they a good citizen? We found that the G aspect of this had the highest correlation with improved returns on our analysis. It wasn't much. The numbers are not very clear on this. They are short term, and they are often back tested and data mined quite heavily to produce the results, and the results are often not that clear. And I don't think for about another 10 years, since ESG has burst sort of onto the scene in the last 4 or 5, that we'll have enough data to really conclude that practicing ESG as a whole or practicing E or S or G based portfolio management does produce a broader social good by seeing if the company's words match their deeds and actions and results over the long term, because a lot of these effects that we are after, either environmental impact, social impact, or even improved corporate governance, take years to come to fruition. So not only do you need to wait to see if the performance is there to get a long enough time frame of actual data, but you also have to assess the companies. And that's the other area of difficulty as a practitioner. And let me know if I'm getting close to running over. And that is the scoring, which was pointed out in the 7 Pillars video. There are multiple scoring agencies that will score companies on an ESG basis. But when you start comparing them and the scores, you will often get very contradictory results. I'll point to Japan Tobacco as a great example. In one database, out of a scale of 100, and I'll common size the scales, they were a 30. Well, they're a tobacco company. I'm not sure this is an inherently dangerous product that adults have to make a decision to use. On the other hand, on another database, they had an 80 score out of 100 because they spend a lot of money on environmental remediation. Tobacco is a very harmful product to the soil. But they spent a lot of money there. In that assessor's eyes, that money spent on environmental boosted them all the way up. There's also a recency bias problem in these scoring methodologies. Companies that do not, that have a catastrophe happen more recently are judged more severely. So from a practitioner's point of view, to a large extent, the beauty is in the eye of the beholder. You need to disclose that to the client, let them know the scoring systems you're using, point out the flaws in them. If they're still acceptable to the client, go ahead. But that's where I think where the ethics come in, the ethical problems can come in, is getting full disclosure. And that's really all I have in formal remarks. I'm not even sure if I'm over or under. Cara, are you? Oh, I think we have to unmute you.
Okay, I'm
There.
unmuted.
I'll mute me.
Sorry, I just at that moment, as in the middle of the video, my electricity died just for about 2 minutes, but that's typical of a Zoom session. But thank you, Chris. And now we'll move on to Josina, and take it away, Josina.
Thank you very much, Cara. Yes, I mean, Zoom, we live in an online world, and we still need electricity. Although I have to say, I was working from Greece this summer, my summer house, and my Wi-Fi was way better than in Brussels, where I'm now. So there you go. Thank you. I'm delighted to be here. I work for CFA Institute, and of course, ethics is part of our DNA. And when we look at ESG and ethics, or can the two combine? That is a big argument. I love the video. I think it threw up a lot of questions that I am dealing with in my daily job, which is looking at regulation, specifically EU regulation. And I will share some of the thoughts and sort of discussions I've been having with regulators and stakeholders. I would say that on World Value Day, there are 3 T's for me. And the T's are trust, transparency, and team spirit. Transparency, Chris, you mentioned it, trust as well. Team spirit is another one. The financial industry is not a lone player. It is part of an economy. It's part of a system. These are people working in the industry, and they should see the investors as people. We're all in this together. The financial industry has its own issues, but if you look at, and of course I represent professionals who work in the industry rather than firms, and I think that's where my view comes from, because these professionals are very aware that they also have issues with their own pensions, with their own investments. So that's a different take than if it's a firm, which is a sort of outsider, sort of disembodied voice looking at all of this. And I think that's important. It's important to think it's a team. And I will go from the team to the triangle. The triangle is at the heart of it has the investor. The investor has the 3 points, which is business conduct, product governance, and financial education. And the 3 should be in harmony, not one over-dominating from the other. I would say that the most important one is business conduct and fiduciary responsibility when we look at retail investors. You cannot presume that kind of knowledge that would enable a retail investor to understand exactly what he's investing in. It will never work. I was in another conference this morning and I was saying, I am totally tech incompetent. When I look at a car, I just want it to drive. And I trust the garage and the people that sold me the car and the name of the car, that it actually will just get me somewhere. I am not going to look into the motor of that car and say, oh, this works and this is working and this. No, I will not do that. So I'm a reasonable adult, but that is, I think, the premises we have to work from. We look at product governance, and again, product governance is important because that's when regulators will look at, is the product being sold in the right way? That oversight is important because regulation is increasingly complex. It's complex for those that make the products, it's complex for those that buy the product. So product governance is at the heart of it. And lastly, financial education. How much do you educate? Do you put that onus on that investor? Well, I think, we can do some education to understand that enough to say that I need to choose the right financial advisor. And I want more or less, this is the idea I have in my mind. But then again, ESG is all about aspirations. It's about doing good. And in COVID times, this is becoming more important. We're realizing the model of the world we live in is finite. Investors increasingly talk about what they really want to do. There's far more aspiration and do good, but that is very dangerous because greenwashing can then come in and say, oh, this is ethical, this is a green product, you're contributing to saving the world, the economy, etc. And we see cases of this arising throughout Europe, which is mainly where I'm looking at. So then you get to regulation. Regulation in COVID times, where we have been focusing so much on ESG regulation, at least in the EU, which is one of the forerunners of regulation on ESG. And you see that our members in a COVID survey we did, I love the fact we do COVID surveys, in a COVID survey, and I would like you all to go to our website and look at it because it's very interesting stuff. The majority of our members think that regulators ought not to abandon or sort of lighten regulation, but they do think that regulation should be pragmatic, and they do warn against mis-selling issues for final investors. And of course, ESG, which is at the moment very much on the forefront of EU regulation, is complicated. If you look at the 3 regulations that have come out, which are concerning disclosures, the building of a taxonomy and benchmarks, you see that there is already, let's say, between the disclosures that are in that EU regulation and another regulation which deals with non-financial disclosures regulatory, as in financial reporting, are not entirely matched. So it is difficult, and the confusion is rife at the moment. We have been looking, of course, at looking what are the issues around ESG and sort of, let's say, far more the governance. And I thank you, Chris, for taking out the E, the S, and the G, because we talk about ESG as if it's one thing. It's not. It's the environment, it's the social, and it's the governance. We have in Europe run away on the train that is climate change. So not even environment, but climate change, we're running away with it. And, we have sort of done a little bit on social because of COVID. We're starting to realize that the social part is incredibly important. Indeed, in France, for those of you that know, there's a new law out there where companies can say and qualify themselves as company with a social good for purpose. Danone, the food and beverage company, has just relabeled themselves as that. How do you analyze that? Does an investor really understand that? And then we come to the G part. Now, the G to our mind at CFA Institute, and we've done we did a report on corporate governance in 2016, and we're redoing one now, which will be out hopefully in January, where we look at sustainable corporate governance. We engaged with institutional investors, and really what we see there is that it's the communication, but really also the sort of responsibility of the company. The company, the board of the company needs to communicate. Now, in times of COVID, when we're all online, this communication might seem to be easier online, but we've seen, for example, with annual report presentations, or that the small investor hardly gets a voice, and that it's only very big investors that get a voice. So that is the problem of communication again. So incredibly complex world that we are when we look at sort of what is green, is it interesting for a final investor? And I would say that that then comes, we've done some research together with a financial users organization called Better Finance, which regroups financial users throughout Europe. And we found that the real crucial element between our two organizations when we look at sustainable investing was fiduciary duty. That really was top of the agenda. And then we go to organizations like the International Organization of Securities Regulators, IOSCO. They have put business conduct at the top of their agenda. The European Commission has put business conduct as the top of their agenda. And I think that is showing you what is going to be important. And I would say that is part of that ethical aspect of what ESG investing is. And I will stop there.
Thank you, Josina. That was very enlightening. I'm sure you're going to have a lot of questions coming up soon. So before we go to questions, we'll finish off with Ruth, who will give us her take on ESG investing and what she thinks about it. Go ahead, Ruth.
Right, so rather, in a way, what I really want to do is to react a bit to what I've heard so far. So just a couple of words about who I am. I'm a former corporate lawyer, head of integrity at a multinational company. And about 9 or 10 years ago, I started working as a consultant, helping organizations to create values-based ethical cultures. And 3 years ago, I co-authored this book, Ethical Business Practice and Regulation, which is aimed at both businesses and regulators to help them understand that compliance is not necessarily the way to change future behavior, and that you really need to look at the culture and the values of an organization. So I'm quite interested in the governance part of the equation, although obviously as a human in all of it. But I would just, I guess, like to raise a few concerns about what so far maybe a little bit, and talk about a little bit of what's going on in other places. I think one of the biggest investors in the world is the Norwegian pension fund, the sovereign wealth fund, the Norges fund, and they have been doing sort of ethical investing for over 20 years. And they've been working together, for example, with CDP, which is one of the NGOs that started out as a climate change disclosure platform and has branched out into water management and forestry. And there are a lot of other efforts to deal with some of the issues which Chris and Josina have rightly raised. I'm not for a minute suggesting that there aren't issues around transparency, different standards, et cetera, in ESG investing. But one of the things that this kind of conversation raises with me is, in a way, the early days of much more effort and attention put on anti-bribery and corruption. And the organizations that started early on to be more transparent issues that they had, or to try to improve, were immediately pounced upon by NGOs and criticized. And at the time, I remember going to a conference here in London on the 9th of December, which is sort of human rights anti-corruption day, and people getting up and saying to the NGOs who were also there, it was a broad group of people, if you are going to jump on the heads of the people who are trying to get better, then what kind of an example does that make for the others? They're all back in their hole. So there has to be some tolerance for the fact that this is an evolution, that we're all feeling our way, trying to get better and better. And there are several different organizations. There's this SASB, which is got materiality standards around all of the different elements of ESG investing, including governance. And there's CDP, and there are many others who are working towards trying to make these things more consistent so that an investor could compare. And also, as the Norwegian pension fund says, really we need more policy on this, and we need a stronger sort of collective view on what good looks like. So obviously the example of the tobacco company is a really good example, that you can look at it in two different ways and come up with two different answers. But if you have a standard that makes it clear how you are coming to that, then people can judge for themselves. And the Norwegian Sovereign Wealth Fund, for example, they don't invest in defense companies, they don't invest in tobacco, and they divest from companies whose record on these issues on corruption and this sort of thing, they find going against their values. And you know, true that people invest for profit, but if you have a choice in what you're investing, is there any reason why you wouldn't use your money to generate the kind of world that you want to see? And I think that there is, you know, certainly very good intention behind ESG investing, but it's perfect. So I would rather see us working to fix the issues so that things are more transparent, et cetera, rather than being so critical. I mean, the other thing is there are things like B Corp, which is what Danone has done. They've become a B Corp. And it's very clear you can go to the B Corp website and understand what does a company have to do in order to qualify as a B Corp. So I think more and more we're trying to get organizations to focus on purpose, having a social purpose, and thinking in terms of the long term. I mean, the Norwegian pension fund is very clear. They think that ESG investing is important because in the long run, their portfolio will be less risky if they're not invested in companies who are likely in the future to be unsustainable. So, I mean, those are a few things that I'd like to raise and to debate. And I don't know, Kara, do you want to say a few words before we also open up to questions from other people?
Thanks, Ruth. That is a good question that you put about, you know, basically you're just asking a utilitarian question, which is the benefit of ESG investing outweigh the disbenefits, which, you know, is a different question from the one asked in the video, because in the video it's just a moral duty to stick to a moral principle. So if you look at the utilitarian argument, I'm not sure yet if the good outweighs the bad yet, because as Chris has said, it's a very long-term project. And I believe that we have gone through this in many iterations. We've had, you know, socially responsible investing. It used to be called SRI. And then after that, it used to be ethical investing, which is, and then they morphed somehow into ESG. So I'm just worried that this label will be taken up by all the corporations just to give themselves cover and not really doing anything in depth to actually change the situation.
Kara, one other thing, I think, you know, it's increasingly difficult for greenwashing. I'm not saying greenwashing doesn't exist, But it's increasingly difficult for a company to get away with greenwashing for a number of reasons. First of all, if they're disclosing through a platform like CDP or one of these others, it will be, their rating will not be good. And secondly, there's so much more transparency and so many ways for people to find out things and for communication to spread, that I think that companies that are engaged in greenwashing, their reputations ultimately will suffer because they'll be exposed. So it's also a risky strategy for an organization. And I don't think many companies can get away with just publishing their own ESG report with no third-party involvement and have it be very credible. At least that's my impression.
Yeah, I think, Ruth, when you pick up that thing on the sort of third-party involvement on assuring the information that the company is publishing, this is going to be important, and this is going to be growing, especially when you look at issues like the supply chain. When you do due diligence on the supply chain, how far do you go? We've seen again and again in the fashion industry issues coming out there. It's just one example, but there are many. And there is a very good study, by the way, I would point people to, from the European Commission's DG Justice department on due diligence for the supply chain, which came out, and which I would advise people to read, because it highlights through different case studies and examples what the issues are. So that is one. But I feel it's that conversation that is, it was always very static. The let's say the engagement between a company would be very stylized to its investors. And I think that we need, at CFA Institute, we call them fierce conversations. We have them inside CFA Institute. But I quite like that title, a fierce conversation, not being afraid to ask the questions that are difficult, and not being afraid to answer with difficult answers. And I think, a lot of things are going to come out of the woodwork whenever there's a big crisis. And this crisis is totally unlike the financial crisis. This is more like a war. So in this war situation, things are going to come out of the woodwork that, we wish hadn't come. I mean, I look to examples already in COVID times with some of the things that have been coming out, and it is quite phenomenal. So these fierce conversations are going to be very essential, and to get that to get that information flow. My worry is, as I said in my initial statement, is that with online discussions everywhere, it's a smaller investor that will get lost. And we need to make sure that that smaller investor stays on board, is able to ask his asset manager, his trustee, his pension fund the right questions to take forward. So I think that is a challenge.
There's a question for Chris. Do you think asset management firms need to get into ESG, considering that it's the only growing area of where inactive management is growing?
Well, I mean, they are getting into it, and it's just it's a market response. There's demand. Can we help satisfy that demand in an intelligent way? And so yes, it is one of the few growing areas inactive. I'm sure it will get overplayed, as all things do in markets, and I'm sure there will be some bad actors, as there will always be, or people who aren't adhering or being as transparent as they should be. But at the end of the day, the key thing is, though, these clients, retail or institutional, are trying to get a return on their money in excess of the cost of their money or the demands on that money in the future. And the fiduciary duty to that must always be fulfilled, and these targets must be met on growth, like for CalPERS 7% investment growth year on year. Good luck. But if there's a demand, we will fill it as honestly and transparently as we can.
Isn't it, and maybe I'd be interested to know your view about this, Chris. I mean, isn't what really is happening and what needs to happen is a fundamental rethink of how capitalism operates, in the sense that this whole idea that Milton Friedman have a shareholder value and ignoring first of all, the only duty of a company was to make money, and secondly, for its shareholders. That's seems to be more and more overrun by the idea that really it's stakeholder capitalism that would bring about the best return, including for the shareholder, because it would take into consideration the needs of all of the stakeholders of the organization, including the non-human ones like the environment. And so do you think that, I mean, you may be cynical about that whole idea, but what do you think about that, and as really what the fundamental change that needs to happen for all of this to be real?
Well, I mean, again, from the practitioner's point of view, having sat in endowment meetings or foundation meetings, investment committee meetings for a number of decades, the fierce conversations we had just simply over trying to allocate assets with purely profit or target returns in mind are exhausting enough. When you throw in, now let's start arguing social issues or things like that, I mean, those will be even more fun as meetings. You know, does capitalism need to change? I think it has changed. It looks very different now than it did 100 or 200 years ago, and it will probably look different in 100 years, with population trends flattening maybe over the next century. Maybe that will change the dynamic as well. You know, regulatory environments are, at least I think in developed and in more sophisticated developing countries, are better than they were. Information systems are better than they were. So some of those externalities that seeking profit causes, negatives, harm to the environment, exploitation of people's daily lives at wages that are too cheap, things like that. I think the regulatory environment can catch up on that. But as far as how to change capitalism and still get the results we all want, which is, you know, I hope a sort of comfortable, peaceful life, I suppose is something we're all after. The change is coming because we've already experienced change. So I wouldn't be surprised if I lived for another 100 years and at the end of it looked very different than it was today. But I won't be around. So.
But I
But
think
it will
there is an
change.
issue of generations. You know, whether you're a millennial or whether you're a baby boomer, there's quite a different expectation of what you want to do. And I think this is the younger generation. When I go and speak at universities, they all say, we want to do something to change this world. And we've seen, of course, the movement with Greta, this student movement. I think there is a different perception of what they want to do, and I think this is inclusive in the way they look at the world, which is sort of not staying within one company for the whole of their lives. Work-life balance is very different. They want to have a life. They want to be in this world. They see it very, very, very differently, and they're not afraid to challenge either. I'll give you an example. It's a fun example of I have a 13-year-old adolescent, and where my adolescence was saying, yes, mother dear, or father dear, no mother, but I would be very polite and obeisant. I get constant challenging, constantly having to defend my positions. Why are you doing this? And I think this why is good. So I have hopes.
That must be.
I'll tell you. Sorry.
I was more like your 13-year-old when I was when I was a kid. Or maybe I'm still that way. Chris, you were going to say something.
You know, I had this revelation reading books to 2-year-olds, or I'm sorry, second graders, and the teacher handed me the book to read, and it was called "If Kids Ran the World." And I said, well, let me give you the bad news and the good news, kids. You're gonna run the world. You know, we will pass it. Yeah. So if this book is not a fairy tale or a fantasy thing, it's going to be on you. You know, and that's the importance of education, is to, and maybe we've done a good job to have questioning people who want change. I mean, change is inevitable. Change is going to happen. It may not be the change we all want. It may not be the change that we want, but we're not going to be here. So, you you know, you do the best you can in your own time frame. ESG is an attempt to express, I think, even as amongst us older people, even without the younger people, the decision makers, like, yeah, I don't want to invest in companies that, you know, chop down forests, or, you know, and we have this problem as international investors. How do I treat my Chinese mainland companies? You know, how do I address, you know, I know in South African mining or this or that, where do I draw the line on this is not acceptable, or there's not enough governance? We generally try to draw those lines, but, you know, it's we'll stay within the lines as best we can. So,
but I think,
anyway.
I mean, Chris, what you've just said brings up another question. I think, I mean, I don't know if this is the next big thing in ESG, but, you know, now we're hearing about impact investing. And, you know, isn't what you're saying, and I think what impact investing is saying, that you have to price in the damage that a company is doing. In other words, if you just look at things from a financial perspective and you don't put in the cost, the environmental cost, the social cost, then in a sense, the balance sheet is being misrepresented, because those costs have to be dealt with.
Yeah, here's a great example. Bayer, German company, buys Monsanto with Roundup. Roundup, let's just agree, questionable, gray area, science, both sides. Wish it didn't get into food supply. Apparently has a relationship with non-Hodgkin's lymphoma that's enough for Bayer to cough up $10 to $12 billion. But here's the deal. Just like with cigarettes, Roundup is going to continue to be sold, or glyphosates are going to continue to be sold, because Brazil tried to ban it. They can't grow enough food if you can't control some of these weeds. So there's a trade-off. It's not that, it's just, you know, there's a trade-off there. Genetically modified seeds that can resist drought would be great for countries that are subject to more drought. But some people object to the fact that there's genetic modification going on. You know, it's a brave new world. Who knows? But I mean, that's what you struggle with as the practitioner, because you're at the tip of the spear, at the point of, is this actually E, S, or G compliant, or whatever the client's desire is? How much, you know, we own Dick's Sporting Goods. They sold guns in some stores. Some clients say, okay, if they don't have more than 10% of their sales dedicated, you know, there's just, you're right. I mean, we get that.
Where
like,
you draw the line, yeah.
Yeah, I mean,
I think the main view that the video was trying to pass on to its viewership was that ESG companies or ESG investment firms should be very clear, and we're going back to transparency, that sometimes there is going to be sacrifice. There is going to be sacrifice for profits, for good. But I have been to a lot of investing for good conferences where hedge funds, you know, have come up and said, we are a no sacrifice fund. And I think that is disingenuous, because you're telling people you can have everything. And I want it to be clearer that you can't have everything. You can't have profits and good all the time. Sometimes you must choose. And I think investors have been trained by investment management companies to believe that you can have good returns and good investing in the good. And I'm not sure if that is actually very true. And I think there should be more transparency.
I think that would be a great subject for another discussion. I know we're running out of time, but, you know, working in the area of business ethics, it's very clear to me, and I've been working in this area for almost 20 years, it's very clear to me that companies that have better governance, better ethical behavior, cultures that promote doing the right thing, are going to have better financial returns, even in the short run. I mean, I've read when I was doing some of the research for this book, you know, even companies that people say, well, you know, you pay a bribe to have a short-term advantage. Well, it has been pretty much proven that you don't get any advantage when you're a bribe payer for a variety of reasons. But I think we ought to debate that, because I think there are going to be views in both ways. But there are a lot of reasons why, for example, an ethical and well-governed company is going to be more financially successful in the medium to long term, and even the short.
We've mentioned Danone today, yes, as is one of our holdings. And I'm glad they're very socially responsible and they sell very tasty, healthful products. but it hadn't showed up in our returns yet. And it's not, we're not running it. The funds we run on my team are not ESG. They'll be restricted if you want, but at the end of the day, for me, Danone, however they're designated, has got to get their margins up and stop being a laggard, or dissolve yourself and hand the capital back. If you cannot earn returns on it under the rules of the game now, just hand it back.
I think, Chris and Ruth, one of the interesting things, and I know we have very little time, but a pointer for future discussions is also what COVID has done. COVID, sort of typical luxury companies that were not really renowned for ESG, right? And especially in the fashion industry, where there were all these issues on the supply chain and whatever. So you have Louis Vuitton turning its perfume factories to make hand gel for hospitals. Yeah. Now, a good PR exercise. And the thing is, will this follow through this discussion, that if companies are willing to act in times of crisis and to show a conscience for the good of society, and how that discussion, I'm quite curious on that, and I would love to take that further.
I mean, I think there are signs. I think certainly the fashion industry is completely trying to rethink itself and realizing that what it was doing before was unsustainable. I think COVID will bring people, some people, to realize that things, I think we're not going to go back to the way things were before, and that this is a great opportunity, despite all the tragedy. There is opportunity to rethink a more sustainable, and people will have to, because of the financial situation that we are all in. So sometimes, never waste a good crisis. There's a question in the chat, which I think it's only fair that we get to before we close. It's about the lack of the intersection between ESG investing and university endowments. Saying, in terms of purchasing assets for university endowments, why is there so little pressure on the endowments to follow ESG principles? And with respect to the use of endowment returns, considering the S and the G in ESG, why is there not more pressure on the endowments to use those returns to help students, for example, suffering financial difficulties caused by the pandemic, et cetera? I don't know if anyone has any knowledge of university endowments, but if you do, you have any answers?
I think this is part of that same conversation when, companies and, again, sort of companies and investment companies are going to have to think about whether they are acting with a purpose. In a recent roundtable of CEOs of investment management companies, there was already a discussion on this, saying, we have now got to be accountable. We have to show our purpose. And I think that goes a little bit to this question, but I think this is a big topic that needs to be explored more.
Well, it seems like we have lots of food for additional discussions if anyone's up for it. I think that was really interesting. Kara, do you want to sort of take over and round us off?
Sure. Thank you very much for all the participation in our panels. And as Liz has said, this session has been recorded. So all of you who want to put it on your social media or the LinkedIn to just spread the word, because I know a lot of people couldn't show up because of the time differences around the world. So we lost a lot of the antipodes from that. And probably after 5 o'clock, people are so tired of Zooming in Europe that we didn't get a lot of Zoom participants. But this will be up on a line, and then hopefully next year we can continue the conversation, and Chris will donate for another video that we can make. But thank you, everyone, and we'll see you real soon.
Thank you.
Thanks, everyone. Bye.
Bye.
Bye.